Hi, I'm Jimmy. In this video, we're going to look at Alibaba's stock, ticker symbol BABA. So we're going to look quickly at the basics of Alibaba's business, and then we're going to dive into how they're being affected by the coronavirus, and then we'll use that to try to come up with a fair value for Alibaba stock using a discounted free cash flow valuation method. Okay, now let's start with Alibaba's business. Some people call it the Amazon of China. Okay, so I broke Alibaba's business into four main segments. Now, I broke these segments according to how much revenue they put up, and I got this off of their last annual report, which was as of the end of March 2019, so it's mostly 2018 numbers. Now, I was curious if things changed a ton since then, so I checked the past 4 quarters, and over the past 4 quarters, things are about the same. Now, I do think it's important to mention that Alibaba is actually reporting their earnings in about a week or so on May 22nd. Then I think it's important to mention that Alibaba owns a piece of a company called Ant Financial. They own about a third of that company. And we don't see that in this chart, even though Ant Financial is quite a big company. They have something called Alipay, and a lot of transactions on their platform are run through Ant Financial. But that's they don't own a controlling stake, so we don't see that here. Okay, so Alibaba's largest segment is their core commerce segment, which operates in a few different business lines. They have Alibaba.com, which is a wholesale marketplace. Then they have 1688.com. This is one of the leading business-to-business marketplaces in China. And then they have Taobao.com and Tmall.com. Both they're broadly integrated with each other, but they're actually quite separate. Taobao is a place where you can find almost any product, and almost anybody can sell their products on that platform. Then Tmall is where we would find more authorized sellers. So these are more brand name sellers, and they've been authorized by the platform. So that's sort of a key distinction. The core commerce segment accounted for about 86% of revenue, both in 2018, which is really what this is, and then also in the past 4 quarters. Then they have their cloud computing segment, which brought in about 7% of revenue. So the Alibaba Cloud offers nearly everything from large-scale computing to data storage, security management, app services, big data analytics, machine learning, and the list goes on and on. Okay, then we have digital media and entertainment. This segment has a lot of digital entertainment, obviously. They have Alibaba Pictures, they have newsfeed, music, they control Youku, which is the 3rd largest video platform in China. And then when we jump over to their smallest segment, which is innovation initiatives. Here they have smaller things like AMAP, which is a navigation app, and they do real-time traffic, sort of like a Google Maps, but for China. Then they also have DingTalk, which is a text messaging and voicemail platform. Okay, so they're really a really comprehensive business, a lot like Amazon. But now this brings us to the coronavirus. So much like the rest of the world, it's expected that consumer spending is going to be down quite a bit in China, and clearly this is going to affect Alibaba's revenue and profits. Now, this is Alibaba's revenue going back to 2013, and as we can see, analyst estimates have their revenue continuing to grow. Those are the ones in the green bars. But then there are estimates for margins. Margins seem like they're going to drop from the previous year, and part of the reason for that is because there are some business lines, things like cloud digital entertainment, that are doing quite well, but they're not nearly as profitable as some of the things like Tmall and Taobao. So basically margins are being compressed, but revenue could keep growing. Now, when they announce earnings, they're announcing the 4th quarter earnings, so we're going to see a lot more of how the coronavirus has really affected them then. For our sake, we're looking for more bigger picture and trying to determine the fair value of Alibaba stock using discounted cash flow. So what they do in the next quarter, or even the next few quarters, is less important versus the overall trend of the business. Okay, so this is the results of our discounted free cash flow valuation for Alibaba stock. So what we did here is we took analyst estimates, and those are analyst estimates for free cash flow that are going out the next few years. We then discounted those by a required rate of return of 7.5%. Now, if you're not 100% sure how I did all of this, I actually put together a discounted free cash flow video where I go through a sort of step-by-step guide as to how to do all of this. And I even put together an Excel template, and you can get to that in that video. If you're curious, I'll leave a link in the description below. Now, to come up with the total value of Alibaba, we needed to figure out how fast we think the company is going to grow forever. That's the perpetual growth rate. For that, I used 2.5%, which is generally accepted as a fair rate to use. But most of the companies that I analyze are US companies, And that 2.5% is right around the long-term expected growth of the US economy. Alibaba, on the other hand, is a Chinese company, and even though China's broader economic growth rate has been slowing, it is still much higher than 2.5%. Of course, ignoring the current pullback from the coronavirus. I'm talking long-term, next 30 years. How fast is every country going to grow? How fast is the US going to grow? How fast is China going to grow? But this perpetual growth rate is crucial when we're using a discounted free cash flow valuation method. Just to illustrate, if we shifted this growth rate from 2.5% to 3.5%, our fair value would jump to $243. And that's because the perpetual growth rate assumes the company will grow at that rate forever. So by taking a more conservative number, which is a lower number in this case, by taking a more conservative number, you're going to get a lower fair value of the stock. I prefer to be conservative, so I stuck with 2.5%. And that gives us our fair value of about $199 per share. But we can't stop there because, as anybody who might have seen some of my other company analysis videos, and as anybody knows, sometimes I like to include debt if it makes a big enough impact on the overall value of the company. Because we should remember that the concept of discounted free cash flow is that this is the value of the present value. This is the present value of all future free cash flows. But if the company has a large debt number, well, it's important for us to account for that when we're trying to figure out what today's value is. So this is the adjustment that I added to Alibaba's fair value. And we may notice that with this net debt adjustment, well, the fair value actually went up. And that's because Alibaba actually has a positive net debt. They have about $20 billion in debt, but they have almost $77 billion in cash. So where this value would normally drop in value, since most companies have more debt than they have cash, in Alibaba's case, the value went up. And if we're curious, these cash numbers and debt numbers I actually got from the third quarter from last year. So they're doing the fourth quarter on the 22nd, last quarter. I like to use the most recent quarterly or annual filing, whatever the most recent filing is, because that gives us the most up-to-date cash and debt numbers. So given that Alibaba is currently trading right around $200 per share, well, this $224 fair value seems like there's some potential upside here, a bit more than 10%. Now, this does look somewhat appealing, but for me, I would prefer a larger margin of safety. Now, I do think that we use some conservative numbers as far as the perpetual growth rate is concerned, but I would still personally like to see a bigger gap between our entry price and our calculation of fair value. Now, if you're curious to better understand how to apply or how I apply a margin of safety to different investments, I actually did a video on that. It's called When to Buy a Stock, and I go in detail over a few different examples of different companies that I've analyzed on this channel and how we can use our research to determine our own margin of safety. If you're curious, there's a link right here. There's a link in the description below. And I want to thank you so much for sticking with me all the way into the video. I really appreciate it. Thanks, and I'll see you in the next video.